Welcome to Inside Scoop with Sean Emory. Every week we are examining something new, bringing you closer to companies, sectors, and themes. This recording should not be construed as a substitute for personalized individual advice from Avery & Company or any guest on the show. This is for educational purposes only and not intended to make an offer or solicitation for any companies or securities mentioned. With that, let's get on with the episode. All right, we're here with Seth Golden. Seth, how you doing?
I'm doing well, trying to hunker down for this hurricane on our back steps right now.
Yeah, I had a 10-minute no power last night, and hopefully that's the worst of any of it. I woke up sweating, so I knew there was something wrong. I have two kids, so when the sound machines go off and my fan stops working and I hear just wind, it was kind of spooky, to be honest with you. It's been a long time since my house has been kind of dead silent in the middle of the night, but it's creeping your way. So hopefully you are prepared.
Yeah, I'm hoping that it dies down a bit before it gets over me. But like we're right smack in the kind of north central area of Florida, so which is in the path, in the cone, if you will. But hopefully it goes from a 3 down to a 1 by it gets to me. And I've been through a Hurricane Andrew in the 1990s, so I can get through this one. That was one where it was. And you thought for a second there, okay, at least I'll see a smiling face when I get to heaven. But
right, that was I think 92. Inflation was running what then?
Maybe 2-3%, a lot lower than today.
Yeah, I think a couple years before that, inflation hit 5%.
Yeah.
And then they were cutting rates, and inflation took care of itself, which is pretty interesting times, to say the least. Having you on here and switching to kind of do it, you're a veteran in the space, and you and I kind of dialogue what seems to be more and more frequently via Twitter. So you can obviously follow both of us and get some interesting insights. We kind of, I think, cross paths in terms of mindset from time to time. And I don't know if it's Twitter showing that to us and kind of, saying, hey, you guys are saying the same thing or similar things. And
those Twitter algorithms work nicely.
Yeah. So it's definitely interesting to see. So today I wanted to really bring you on. You lead the Finum group, and essentially, your backdrop is really around macro volatility, derivatives, and kind of the construct of volatility in general. My background is much more around, call it the micro, the company specific fundamentals of business and industries. Not that we don't kind of overlap in terms of our experience and education, but it's really to have a dialogue around a couple different pillars, which is, the current state of inflation. I think there's so many interesting ways to look at it, whether it's, we've historically focused on kind of PCE. All of a sudden we're focused on PCI or CPI. And then there's other ways to cut it. And then there's kind of high frequency data that says one thing potentially, and the actual reports that say another. And kind of that's step one. And then as we think about it, going through the journey, the economy, the shape that it's in, should we enter any sort of economic uncertainty or more uncertainty, sentiment, how that feels today, and any data around that, valuations. I think that's always important in general, but looking at it a much broader view. And then, the Fed, I think we'll leave it for last is, can they pause? Do they keep going? Are they a freight train going right through it? Or are they this hurricane that, once it hits land, it turns into a 1 and troubles the storm and goes away? And then anything else, and we'll just go from there. So, I'll pull up a chart, and I think for the purpose of this is here, which is, I find it fascinating that the Fed historically, for the last, I think, 2 decades, maybe 3, has focused on PCE as a mechanism to first they forecast it, right? Yeah, we're hearing everything around CPI.
Yeah.
And I don't know what your initial thoughts are. 2023, I think they have a sub 3% PCE inflation reading. There's different ways of breaking down the two reports and indices, and I'll share some of that. But your headline view or thoughts around inflation more broadly.
Okay, yeah. So just like you, I mean, I cut my teeth on fundamental analysis, macroeconomic analysis in my earlier years, mainly because I can't see color. And charting for me was just going to be a nightmare because all platforms have charts in various colors. And I got my first degree in English education, so I'm a good reader. So I can read 10K filings and all the different transcripts from quarterly reports and everything. So that's how I got a broader perspective on investing and the business cycles. From an inflation standpoint, yeah, absolutely right. Fed for the last couple of decades, 25 years, trying to get inflation into this economy, whereby technology was broadly siphoning it out year after year after year through technological advances. I don't need a Rolodex. I don't need a landline phone. You think of all the things that you used to have to, buy as a goods that you don't need anymore. They're being supplanted by services that are less costly. So for the last 25 years, the Fed is trying to generate some degree of inflation and pricing power for the vendors, the wholesalers, and the retailers, and they just couldn't do it. And looking at the PCE, the reality is the PCE, kind of differentiating PCE versus the CPI, the Consumer Price Index. You get a big distortion there because, for the most part, we all at some point will have medical costs, especially as we get younger with time. Obviously, we don't get younger with time. We get older and we get more
Really
medical
hope.
costs. I guess that was just wishful thinking on my part that I'll be the first Benjamin Button in real life, right? But the PCE, that healthcare component is almost non-existent. Whereas in the CPI, it plays a bigger role. So you tend to see better ratings in the PCE than you do in the CPI. And we're at that place in time where we finally have inflation, too much inflation, and now we have to stomp it out for to get price equilibrium in the economy. I do tend to agree with the Fed so far as that is a utmost importance. If we don't deal with inflation today, it'll have ramifications for decades down the line. But where is that optimal point? Is it 2%, the Fed's target rate, or is it 3% now? I mean, if we look at all the fiscal policy initiatives that help to generate this type of inflation, forget about the supply lines for a second. It's not just that the Fed's easy policy contributed to it. It's also on the fiscal side. I mean, we got checks from the government for months on end, it seemed, during the pandemic, and we couldn't really use them. So they went into our savings accounts and checkings accounts. And now we literally have 4x any time in history, the average checking account, the data that we can aggregate from JP Morgan or Chase Bank or Bank of America, the average household checking account and savings account is 4x any other time in history. So of course, that was fiscal policy side of generating this kind of inflation. And that savings doesn't go away right away. And to the extent that the Fed is trying to stamp it down, you're actually going to get to a mean reversion point in those checking and savings account that is still higher than where we were in the past 20, 30, and 40-year period. So if we look at inflation, what is the ideal target rate for the Fed? Should it be back to where it was pre-pandemic when savings and checkings are much higher and where wages are much higher? Or should it be somewhere around 3%? Not forgetting that in 2019, the Fed adjusted its target inflation rate from 2% to an average of 2%. They would like to see it above 2% for a certain period of time and below 2%. And so it would be an average. Now, nobody ever defined how much time above or below would constitute the average, which I thought was funny in and of itself. But here we are now seeing the Fed talk tough, getting back to the prior mandate of 2%. So I look at it from the standpoint of we'll fix it. In time, these things work themselves out. They feel, as an investor or as a trader, they feel very arduous, and it's a daunting time for investors. And the lower income decile households are having a tough time with inflation as well. But these kinds of economic business cycles work themselves out over time. This is not going to be the thing that creates the zombie apocalypse, if you will.
Yeah.
So.
Yeah, I tend to agree. I have an interesting, point that I tried to make, I think like a week ago, which was like PCE versus CPI. And I find it just like, this is a tweet that I made, but it's pretty archaic in terms of how some of the stuff is calculated, where,
Yeah.
CPI is taking a basket from 2 years ago, constructing
Hmm.
it, and then revisiting it every 2 years. And, I think that works normally, where, growth is at 1-2%, and, inflation's at 1-2%. And you kind of get this, steady as she goes,
Right.
cruise ship moving down the ocean.
Right.
But it's really when you actually need it the most that these this practice doesn't work where, PCE is updated, frequently, much more frequently in terms of monthly as opposed to yearly. I mean, biannually. Um, and, I think that distorts a lot of things because if, again, fast or backtrack, 2.5 years ago now, because we're still in that biannual period. Um, what were we spending on? And all that is being weight adjusted in these indices. And it's partially probably why we have this 2% gap between the two.
Right.
But it's also probably why the Fed shifted partially to moving to a PCE focused metric as opposed to a CPI. I find it strange that, again, your goal is PCE, you're talking CPI.
Right.
In the back of my brain, I think political stuff, we're here, and we've tried to think about it internally, which is, November is the elections and at the heart, and again, hopefully there's none of this influence inside. But it's more around, I think I try to think of both sides, which is, if CPI is rising, and you're not making tangible efforts to control it, which you should be, but making sure that it's, there's 100% dedication to it and there's no wiggle room at all. Some will call
Right.
that, credibility. And then the other side, which is really around, well, let's squash it because, if you go too aggressive in terms of squashing inflation, well, either way, it's a win-win, right? For that side. And again, I'm not trying to we're like pretty apolitical here, but it's more thinking about, why you think 2.8% inflation is around the corner in terms of PCE, why you're focusing on it, yet talking CPI. So it's just an interesting concept and maybe
Yep.
something to chew on for a little bit. Now, I think, and again, I've seen some of your charts as well. I think we both tweeted this chart recently, which is really
Mhm.
around apartment lists. So one of the stickier points of inflation has really been, home housing inflation. It's pretty obvious, if you are tracking any sort of data, that a lot of this stuff has been decelerating and or outright declining recently. Apartment List just updated their numbers yesterday, I believe.
Yep.
And just any findings, like your takeaway. I saw you tweeted about it again. I think I tweeted about it as well, and something that we've been tracking. But general takeaways on like housing and some other inflation indicators that you think are positives.
Um, the one big positive, because the housing component and owner's equivalent rent component of CPI are just they work with an egregious lag. And the question, like, it's a survey, right? It's a survey. They literally will ask a homeowner, what do you think you can achieve if you put your house on the market for rent? Now, the homeowners know generally, about what it would be. They have neighbors maybe that have rented or just in the area that they live, but that's how they surmise the owner's equivalent rent component in CPI, which to me is extremely,
Archaic.
superficial or archaic, if you will. I just, it's so demonstrative to do it that way, I think, to the credibility of the CPI report.
Right.
And I've done some research on so far as the biggest problem is not just how the survey is offered and how the data is gathered, but the lag time. The lag time between um, the deflationary impacts can be upwards of 6 months before it's actually reflected in the CPI. The positive, finally, they realize this. There's actually going to be an adjustment come January 2023 CPI report. They are making an inclusion. There's a new methodology that they're going to be using. They tested it from 2013 to 2016's data because that was one of the more stable, monotone periods of economic activity in the U.S. Going back to 10 years and past the point of the impacts from the great financial crisis. And what they found is that it would actually shave off about a quarter percent in that owner's equivalent rent using this methodology. So, the central bank, the Federal Reserve, the government, statistic Census Bureau, they know there's a problem with that key line item so far as owner's equivalent rent. I'm of the opinion that we started to see the rollover on a month over month basis because that's what everybody's focused on this point. It's month over month, year over year. That'll take care of itself. But the month over month is going to capture the rate of change. A lot of people get confused. They think, well, prices are still going up on a year over year basis. How can CPI go down? And CPI doesn't capture whether prices are going up or down. It's capturing the rate of change in price. To your point or earlier, if you look back 2 years, there's not a lot of volatility in price. But in real time, you get some of that rate of change. And as you get the deflationary spiral, you'll see a bigger impact in owner's equivalent rent. By my account, I'm thinking the December CPI will show. The unfortunate thing there is that we'll get the December CPI when? In
January.
January of the next year. Um, so, we'll see exactly how this whole new calculation is going to impact, the January CPI. But that is the biggest thing when it comes to, I mean, it's 30%. The housing component or shelter and owner's equivalent rent are 31% of CPI. Everybody was expecting a bigger drop in CPI for the August report because of commodity price deflation, because of gasoline prices and crude, all of the energy components going down, the soft commodities going down. Manheim used car index also, we see that going down. Now it's down on a year over year basis, not just every month, but we're actually have lower used car prices than we did a year ago. Yeah, beautiful chart there.
Yeah,
The
so
only problem, I'm
yeah,
sorry.
just to highlight the chart, just in case most people are going to be listening, we're showing the Manheim index versus the CPI component of used vehicles, and you can see this huge gap. He
Right.
tweeted about it. I've tweeted about it. This is Fun Strats, I believe, original, but
Yep.
in general, it's essentially just showing Manheim, and there's this huge gap that
Mhm.
um, historically has been filled, and
Right.
historically, it's CPI catching up to the Manheim as opposed
Correct.
to Manheim catching up to CPI, which ultimately means this should come down the pipe at some point and become not only a decelerating positive CPI reading, meaning less positive, but actual outright deflation, I guess,
Yeah.
on a month over month basis. In theory, year over year, right? I think that's
Well,
what you were just alluding to. So I'll let
correct.
you
It's
go
now
there.
down year over year as of the mid-September update. Yep. And that's the other thing about CPI is week two to week two. So, I mean, we've been seeing used cars, the Manheim used car index going down pretty consistently. But when you look back at the last CPI report, it's only down 0.1%. That used car component was only down 0.1%. And I was saying, how is this possible? So I did a little bit more research and found out that it's not going to capture the whole month of that used component. So we should actually see the used car component fully capture what has happened as of the August report, let alone the 2 weeks into September. So if you see a bigger decline in Manheim, or I'm sorry, the used car prices component when the September CPI report comes out, it'll basically validate the lag in that report as well. So
Yeah, what
there's a lot of deflationary. I mean, I
forces?
get it. People were looking forward to this last one and saying this is going to be the big CPI report where we get it and markets are going to turn around. The Fed won't have to, be as hawkish. And now we're all looking to the next one.
Yeah, for sure. There's what's interesting too is you can look at wholesale prices to try to figure out what the auction prices at Manheim are. And here's a chart that
Oh,
was
that's
highlighted
beautiful.
yesterday, which is basically showing the Blackbook wholesale price index, which again is a leading indicator for kind of what the consumer eventually sees. And the findings here is essentially that we've seen now, I think 6 weeks in a row of declines in wholesale prices. And we're now tracking 2022 for wholesale prices is now tracking below any year over the last 3 years. And it kind of, they tried to illustrate 2009 as well. And just in general, I think the big takeaway there is that there's more um, kind of deceleration or flat out deflation in used cars and cars in general coming down the pipe. You take 10%, or yeah, 10%. It's roughly like four, I think, percentage points of CPI. You're shaving off almost like 40 basis points or so of month over month inflation at some point, and that may get cut up, like you said, in 2 months versus 1 month. But in general, it's acting as a negative force
Right.
there.
Yep.
Um, you know, Continuing on the path of inflation, because I think it's the topic of du jour, and for rightfully so. I think our whole view is, it really started with the supply chain. If you go back
Yeah.
to along with what you said at the onset, which was around the fiscal side, but you go back, uh, you know, 30 years, right? And I think there was a study done by the Center of Economic Policy Research. And what they tried to understand was how over the last 3 decades, you had things like changes in employment, where there was employment slack or tightness over the last 3 decades at various points. Yet you saw inflation remain in this kind of tight little band.
Mhm.
And you alluded to it before, which was around um, the fact that, whether it's technology, in many cases, this study found that it had a lot to do with the supply chain as we became more uh, global in terms of
Global, yeah,
br-
globalization. Yeah.
yeah, bringing in supplies at a cheaper rate where maybe the costs inside your business were increasing, and instead of manufacturing it here, you exported or you imported and exported your supply chain internationally, and that was essentially the ability to keep your costs down to the end consumer, which kept inflation in a moderate level. And then you go back and you look at when the supply chain costs, and the supply chain bottlenecks were a function of many things. It was everything from, keep 6 feet away from each other. If you catch COVID, you have to be out for 2 weeks, so you couldn't be at the ports. To obviously China shutting down completely, start and stopping. To eventually the prices of fuel increasing and diesel increasing, all the way to things like once it started to build in terms of supply backlogs, what you saw were companies double, triple ordering to ensure that they
Mhm.
had it in stock. So
Yeah.
it became this like virtuous cycle, and the rise in really the cost. I'm talking about like the exponential rise, where it went semi parabolic was in February of 2021, and just before that, I wouldn't say inflation wasn't rising, but it wasn't rising as drastically. You weren't seeing the before that, you didn't see any zero point 0.5 month over month increase in inflation, and thereafter you started to see 0.5, 0.7,
Yeah.
1,
Yeah.
1.1. And so I do think it was a function of the supply chain that led to these rises, because anything going on a 40-foot container that goes from 2,000 to 22,000 ultimately has to cost more.
Right.
There's
Yeah.
there's no way around it. It's like a toll, right? If I have to go somewhere, and I mean ultimately it is a toll, and therefore quote unquote a tax, if you just wanted an analogy, an easy one, to the consumer. And the important aspect of just bringing this up is this right here, which is showing the cost of a 40-foot container from China to, let's just say, the port of Los Angeles. That is down almost 80% from the peak. Really, within the last several months, it's
Yeah.
down 60, 70%. Keep in mind that was when this is when rates were in 2%. Like, we're talking about a Fed funds rate at 2%. We're not talking about the four and a
Right.
half percent rate. So a lot of that supply chain, whether it was demand, but if you look at like volume and imports, they actually stayed pretty constant. They actually didn't increase that much relative to 2019. When you look at 2021 numbers, it was more the bottlenecks, in my
Right.
opinion, and just some data that caused some of that. So I'm bringing this up because if prices of the supply chain are coming down, we should think futuristically that the prices should at least stop rising altogether, which they have in many areas, and or flat out decline. Now, one caveat to that is, and we followed the supply chain pretty closely early on for different reasons, is really a lot of these companies decided to lock in multi-year contracts,
Mhm.
um, at, let's say, $10,000 per container, so that they could lock in 2 years in advance instead of getting the spot rate. And that's kind of now backfired on them, where they still
Right.
hold that 10,000, but it's sitting at 3,000, 4,000, 5,000, and so they still have this carrying cost. Therefore, the slowing effect of, let's say, consumer price maybe lagged. What's your take on supply chains and maybe the implications there? I know you've talked about it as well, and just to firm it up.
Yeah, I'm definitely not an expert on supply chains, but I can offer a lot of anecdotal as well as empirical data to the conversation. I follow the Drurys, the
Yeah,
global world index as well, and I mean the rate that we've seen them decline for containers. You used to we're seeing 1% here this week, maybe 2% on a good week, but now we're seeing drops in consecutive weeks of 5, 7, 10%. I mean, they're literally falling off a cliff, which, to your point, should be good for those goods producing companies that are importing back to the United States. I worked for Target for a number of years. I worked in logistics, so I know how the whole kind of loop works from coming into the port. Your goods are coming into the port on a container. Our truckers would pick up the goods, then it goes to the distribution center. It gets unpacked, then it gets palletized to go to individual Target stores. Now, here's where what I found out so far: supply lines and how difficult it is to shut something down and then reopen it, which speaks to what we tried to do when we shut down the global economy, and then you try to reopen it and think everything's going to go back to normal. So I worked at a declining store. This one particular store was going from about B volume down to C volume, just because of the demographics around it. And what we decided to do was put in a request for lesser freight volume. We weren't selling it. Why are we still getting the B volume freight when we're doing C volume sales? And eventually the district manager went along with it with the forewarning. If things pick up, if the community around you should change and whatnot, it's going to be really difficult when we have to turn the spigot on. It was the exact phrasing. It's easy to shut it off, but when you want to turn it back on, things tend to trip up. And we that store did go through that. Fortunately, did have a resurgence and whatnot. And that's kind of how I think about the whole supply lines and globalization as well. It's incredibly difficult, especially when it's a pandemic situation. You have a viral situation that's going to just have a long lasting effect with people. You literally told the world you got to stay X amount of feet away from each other. That doesn't go away when you reopen the economy. There's still those lingering thoughts among people. As soon as you hear somebody cough, it's like, oh boy, we all go into that. Let me scoot over here. We
Right.
all go into that. So there's still that lingering. And unfortunately, what that produces is a disruption in the labor force. So while we wanted to reopen things and we had goods that needed to be shipped, we didn't have workers. We didn't have folks that were willing or able to come back to the workforce, in the midst of still unknowns about the future state of the global economy. So this created longer lasting ramifications in the whole supply line chain. Now, from a inflation perspective, so I mean, the Fed can't do anything about supply lines. It can't do anything about that other than trying to go backdoor it through the demand side of the equation. So although freight prices are coming down, shipping prices, spot prices are all coming down. What does that mean for CPI? What does that mean for PCE? And what does that mean to the Fed? And the reality that I've come to understand and maybe have known for quite some time is unfortunately nothing. Spot prices going down don't mean anything. And this is why the Fed is essentially right. Spot prices, shipping prices, freight prices, they can all come down. You let me know when your retailers are willing to lower their prices, then it means something. And that's the problem. That's what the Fed has rationalized to themselves is like, it's great. All that stuff coming down is great, but we're still 4x the savings, accrued savings, not the savings rate. That's come way down and is actually below the 10-year average. But the accrued savings still lets people go out there and pay the higher price. So there's no incentive right now. All gasoline prices, energy prices, input material, raw cost prices are all coming way down, 30 and 40% off their highs. When was the last time you saw Target do a buy one, get one free sale? These retailers are still having elevated prices. I'm using Target as an example. They haven't lowered their cost. Their sticker price, on the shelf hasn't really come down incrementally. Inventory overhang be darned. That's the stuff that came in at the wrong time. That's a perfect example of, the supply line glut where retailers that have seasonal goods that were supposed to come in January didn't get there until March or April. And the Easter stuff that they were supposed to get in March and April didn't get there until June, July. That stuff, that's not, as a retailer, there's nothing you could do about that. You order 6 months out in advance. This wasn't the fault of Target. This wasn't the fault of Walmart, this inventory overhang. It's the fault of the supply lines. So that stuff gets discounted and it makes headlines so far as well. That's disinflationary. But it's the everyday stuff. It's your 6-pack of Coca-Cola or Budweiser, whatever you like. It's your Frito-Lay chips that are still, some 25 to 30% above sticker price that they were in the pre-pandemic, economy. So supply lines and all that stuff work themselves out over time. But the only real way to get retailers and get that MSRP down is to hurt demand. It literally is the only way. So I get why the Fed, feels it needs to do what it is doing. If it was me, if I was, in the chairman's position, which never, please, don't put me up for that role. I would never talk about the punching bag of the world. I would let the market, everybody complained. Now, here's the thing. Everybody complains when the Fed steps in to buy you the economy, and doing quantitative easing. I mean, we run to them for help, but then we complain for the next decade about quantitative easing. But when the Fed is forcing us to take our medicine, so to speak, because of all of the, free money and liquidity, people are okay with that. The bears of the punditry, they're okay with, finally, enforcing the the medicine taking when it hurts the economy and we're supposed to get a hard landing. A recession is a normal part of the business cycle. They're okay with that. I'm not. If that's the outcome, that's where I deviate from understanding the Fed's policy. If the policy has a greater than 50%, or the policy have a greater than 50% probability of pushing you into a recession, there's something wrong with the policy mandate, and there's something wrong with the tools to address whether it's inflation or labor.
Yeah, got it. Yeah, so I tend to agree with most of that. The only thing I push back slightly or question or think about is
Yep.
the so the the MSRP that we're talking about in terms of just the price of goods and not
Mhm.
necessarily coming down. I guess the bigger question is, does that price of Fritos have to come down or simply move sideways for the next
Right.
6
Good point.
months?
Yeah.
Because if it goes, I think you've seen plenty of the waterfall charts that show
Mhm.
0.2% month over month inflation readings, whether it's CPI, PCE, core, non-core, over the next, say, 6 months. If you get 0.2, 0.1, 0, somewhere in that ballpark, um, you get overarching inflation in those 4 components,
Right.
anywhere from, actually sub 2 to as high as, 4.2.
Mhm.
Um, and depending on which one you're looking at, but all kind of a lot of progress being done. And the question is, that feed, the loop of the supply chain either declining dramatically, which isn't forcing price increases. You get this plateauing
Mhm.
of so the strange part there is, if demand is actually hit, yet you could make an argument that you could essentially do nothing from here on out in terms of Fed funds and probably get this 0 to maybe
With
0.2
time, yeah, just the
with
natural.
time. Then what happens to the inflation rate should demand actually come down, forcing an onslaught of liquidations, which is why you're starting to hear the conversation around deflation, because it's not that hard just to drum up some math and
Right.
figure out, like, no joke, in a year from now you may be in a deflationary scare, which completely alters the viewpoint of, let's say, the markets, but then the viewpoint of the Fed. And I think we get back into seesaw effect where, and we've been talking about this internally, which is, at the very, or like the start of let's just say COVID, you had the prices of, you had a lot of bullwhipping going on, whether it's, first for physical goods inside of our homes where the prices went up and the demand for that went up and then all went to zero, right?
Mhm.
You could even just say negative because it's there's no demand for some of those things. Then you had, like, obviously online and some other things, demand shoot through the roof. People are talking about 10-year pull forwards and such. Then you're seeing the supply chain costs go up and to dramatic levels and then come all the way back down. You have seen the Fed response be as aggressive as ever. The question is are they going to have the bullwhip effect as well? Given we've already seen almost like 2 to 3 stages of this across physical, digital, supply chains. We've seen it through the entire ecosystem, airfares. Um, that's where I question where it almost seems inevitable if you take everything before it that
Yep.
there was a bullwhip. It
Politics.
seems somewhat inevitable that there's going to be a bullwhip again,
Mhm.
which is going to be the complete opposite side of this. And the question is when, if, how. A lot of the data that I think we just showed and talked about, which is, used cars and some other things, is showing that. I think if you go back a year ago and you read the comments around 40-foot container costs,
Yep.
there was literally the concept that this was going to stay elevated and never get back to the levels seen pre-COVID.
And
And this
nobody would
was,
come back to work. Everybody would, temporary. We'd have I mean, all the commentary around jobs and shipping. It was, yeah. It's just prisoner of the moment thought processes.
yeah, some of it is rational. I get it, because there's no incentive for the carriers to reduce their costs if
Mhm.
they don't have to, but they're being forced to, because now there's more capacity.
Mhm.
Productivity is now flowing.
Right.
What people don't talk about is the order book for new ships is actually at record levels. So these carriers actually ordered out multi years, thinking that this was going to be a structural problem.
Right. I remember
Um,
that from last year. Actually, I saw that
and those
report.
are non-cancelable. This is like
Yep.
Boeing, Airbus. You ordered those
Right.
planes,
Right. Unless you're
so
China. Yeah.
yeah, then you can cancel everything. But yeah, so let's move on, because I think so. To summarize, like, the inflationary area, I think it's kind of this back and forth of somewhat. It's more of a timing thing, really. And
It is.
you're
And
hearing it more and more
something that you had
about the. Go for it. Go for it.
something that you had touched on at the very beginning of our discussion was, politics and things like that. I've always, why don't we let the markets clear? Why don't we let the economy take care of itself? I mean, I've often said when the consumers had enough, they'll tell you. Yeah,
Yeah.
and this will take care of itself. We'll devolve into a recession. We'll clean up and we'll emerge, into a new expansion cycle. What I think has gotten so politicized over, I mean, I'll be 46, so I've heard it for at least the last 20 years that I've been able to understand the concept of uh, the economic divide, the social classes and economic, just the wealth gaps in our society. And we tend to think of the Fed's job as being a means to at least stabilize the lower decile income worker, um, and make sure that the wealth gap just doesn't explode. And that has become central to the punditry of Fed watchers, if you will, and centers around job creation and inflation. To the extent that we've heard time and time again this year during FOMC press conferences about this is more difficult. This inflation is more impactful. It's felt to a greater degree amongst the lower income decile workers. Um, but I've always pushed back on that political aspect because no matter what the Fed has done historically, the wealth gap just widens over time. So even that aspect of, well, the Fed needs to do this for the lower wage workers and those who are considered poverty level. I've said to myself, I've watched the Fed for the last 25 years. No matter whether they were injecting liquidity or they were taking it away, the wealth gap has just completely continued to widen. So that just elevates my point of let the market, let the economy clear. It will take care of itself. When the consumers had enough, they will let you know they've had enough. Why
There,
does the Fed have to intervene?
there was actually a Harvard study that I read not that long ago, which uh, the hypothesis was, does lower rates actually support a faster decline in inflation than opposite? And the rationale was really, and there was some actual data behind it and some research behind it, but it's the thought of, to solve some of these problems, it takes capital. I think, take housing for example. There's an inventory problem.
Right.
And in order to build more homes, you
Yeah.
need access to cheap capital. Um, and it speeds that up, not slows it down. Or now it's slowing it down in terms of raising rates, because that's ultimately, the stickier component of inflation today. Why would you make it harder to build new
Yeah.
homes, which is ultimately the cause, right? Demand was there,
Mhm.
um, and for different reasons, but really the supply is at multi-decade lows.
Yeah,
Um,
it's like a doom loop. Housing is in its own doom loop, where it took the pandemic to realize the doom loop it's in, so far as house supply versus demand, and what would otherwise be ever appreciating prices because of that dynamic.
Sure. Yeah, so let's skip to the
Mhm.
other 5, component of this conversation. We'll go quicker here. I think inflation and kind of the thoughts around it,
Yeah,
we summarized a lot, but let's
top of
just talk about,
mind.
yeah, let's talk about the economy in terms of the shape it's in. I'll let you start off, and then I'll
Sure.
add some stuff.
Yeah, I'll give you my broad strokes. I think the economy is very stable. I think we've entered a period of accelerating growth from the June. I think we kind of troughed, or I should say, uh, you look at GDP, it tells you that we're in a recession. But when you look at the specific components that the National Bureau of Economic Research looks at, they're all in fantastic shape, and they've only grown real income, real retail sales, industrial production, employment. I mean, some of these numbers are above average GDP level metrics. But we did see slowing in that second quarter. But since then, where PMI seemingly have troughed in the second quarter, we've seen new order growth in the ISM manufacturing. We've seen it in the regional manufacturers as well. And the good news is when you get those reports, you also get the prices paid components,
Yep.
which are falling off a cliff now for 2 consecutive months. So from that inflationary standpoint, that's looking good and sustainable. But I mean, the job growth is incredible. We're seeing the wage growth is still very strong. It's not keeping up with the pace of CPI right now, but we're creating about 400,000 jobs over the last 6 months. So we're averaging 400,000 job creation a month over the last 6 months. Uh, the good and bad there is obviously we still have a very tight labor market. Right now, according to the JOLTS, there's literally 2 job openings for every me. So I can work twice if I wanted to.
People were
Um,
doing that. I think,
yeah, yeah. Um, but overall, I think the economy is humming along. You look at retail sales, you look at consumption, and we have never had a recession where you've had annualized retail sales 8% or better. And we're running more than 9% right now on a 12-month annualized basis. And people, will like to throw stones at that and say, well, what about real, inflation adjusted retail sales? Even inflation adjusted is up a tick on a year over year basis. So, you know, the US economy is a consumption based economy. And if the consumer is healthy, they've got a strong balance sheet, they're responsible. And that's the other thing you want to, I mean, I hear and I see through the New York Fed's quarterly household debt and credit card balance report that, some leveraged credit default rates are starting to climb and whatnot, which is normal. That, in my opinion, is just mean reverting. You're always going to, have those pockets. But we went from a period where there were no defaults, and now we're getting some. I mean, there's always going to be some. So I look at the economy and I say it's very healthy. I mean, you can't tell me 8, 9% annualized retail sales is anything but. You can't tell me that you're growing 400,000 jobs a month is anything but. And folks say, well, that's a lagging indicator. Employment's a lagging indicator. I'm like, what? When is it not then? Was it a lagging indicator in January, February,
Right.
March, June? I mean, when is it not going to be a lagging? At some point, you got to realize the trend is strong, and you got to get off of that excuse if you're part of the punditry. Is it a perfect economy? No, it never was. It never will be. We also have to get away from this notion that the Fed and the federal government could ever achieve a perfect economic situation for us. Better is always on the right track.
Yeah. Yeah, to add to that, I think you took, the growth side of the economy and a little bit about what I'm gonna talk about for a second, which is, around the core health, meaning for us, it's really around and always, before you're questioning whether, a certain problem is potentially gonna be another crisis, it's really what's the health, what's the foundational
Yeah.
elements. You talked about jobs, and, obviously there could be layoffs in the future, but jobs now is, people are securing more jobs, therefore more income and more strength and stability, for the economy. But next to that, and you alluded to it before, which is the savings for the consumer. So we like to think of the consumer balance sheet, the housing market. It's usually your biggest asset, your biggest liability in the economy, and also the corporate kind of earnings and margins and earning season and things like that. Now, savings. I'll just pull up a chart here, which is personal savings, and it shows a 24-month cumulative personal savings total $1.9 trillion as of July. Is probably maybe a tick lower than that, but probably pretty much on par. You can see how it went from 1 trillion to really almost 3 trillion. This is aggregate, right? So some of the stuff you were talking about before is bank data, which is arguably just as important, or in some cases more important. And really, just to summarize, there is that the consumer has a massive sum of savings still,
Yep.
um, and that is ultimately a foundation that the
Right.
consumer can sit on. Number two is really around housing, and the way we like to think about it is the quality of the mortgage originations,
Hmm.
and the
Yeah.
amount of equity in these homes. 2008. You think about it, people were buying a 1% down payment and 99% leverage, and one move,
Adjustable rates. Yeah. Hmm.
1% move in your house, and you're ultimately underwater. And today, there's over $1 trillion of equity in these homes. And again, we know things can evaporate quickly, but at the same time, that's a really good starting point if we're talking about foundational elements here. 70% of mortgage originations are that 760 credit score or above. In
Yep.
2004, 5, 6, that was roughly 25%. So it's been flipped on its head in terms of the quality of the buyer. And then lastly, I know it's lagging, but anecdotally, just hearing companies, last quarter, there was roughly, whether it's 7% sales growth and 13% earnings growth for the S&P 500 constituents. Anecdotally, you've actually heard some strengthening over the last month. There was a bunch of conferences that happened. And some of the areas that, let's say, took up more of a pause, let's say a quarter ago, are seeing some inflections. I think it's a function of, Ukraine war began, small business, mid-sized business took a pause, didn't want to take on new tools, new products, new things. And they have kind of, reassessed, and they're like, okay, this is part of the new normal. Um, and you've seen some of that anecdotally. So I'm just adding that just to, uh, attach to the growth components that you just talked about, which I think ultimately shine a fairly constructive light on the health of the economy heading into anything that should be worse or better in the future as we move that direction.
I
Yeah,
also, one of the key metrics that I always look at, it's like just a broad I'm a U.S. household. If I'm a U.S. household, what is um, my household debt service payments as a
Mm,
percent of disposable personal income? And that metric is literally, I mean, since they've been tracking it since the late 1970s, and other than the absolute low in the pandemic, it's at the best levels in 40 years. Essentially saying, once you strip out what my monthly bills are, I have the best amount, the quantity of disposable spending that I've ever had since the 1970s. Yeah, it's just hard to argue that, you know, the Fed's going to do what it's going to do. The uncertainty around the Ukraine Russian war will have hiccups in energy prices and things like that. We just had $5 a gallon as a national average at the price, the price at the pump, and we went right through it, with climbing retail sales. And it goes back to the household corporate balance sheets. Yeah, forget about it. I mean, they're in fantastic shape too. But those household balance sheets, I mean, that's the lifeline of this economy. And if they're wrong and they believe that they have a coming, and if they don't have one from this job that they can get another job, they're going to spend. Paychecks get spent here in the United States.
yeah, cool. Now that makes a lot of sense. And gas is at 378 today, and that's with
Yeah.
Hurricane Ian. Um, Next is sentiment. I have this one chart. I don't know if you saw it yesterday, which shows the amount of option traders spending a
Yeah.
bucket load on protection.
Yeah.
So here's a chart on for options, and I know this is like right up your wheelhouse in a sense in terms of just part of the market, right? And just in general, we're showing a chart of basically the S&P 500 and the retail put option premiums in terms of option demand relative to the size of the market. So as a percent of stock market capitalization, and it shows 4.5%. Essentially today, March 20 of 2020, you could argue this scariest of times. You weren't going to the grocery store or anything. That was also 4.5%. And then you go to October of 2008, 5.4%. If you looked at this chart, there's only really three spikes going back,
Right.
25 years. And it was really these three times, and they're both kind of equivalent. So the takeaway there is not necessarily is this the low or is that the low. It's more, sentiment is a reaction to fear, or it's essentially the summary of fear, I guess. And just your take on sentiment today and how that could potentially be the catalyst. It's weird to say catalyst, but maybe the buffering of stock market weakness
Mhm.
going forward, given everything we just talked about, which was, I think,
Right.
the first two sections, inflation being, there's a lot of stuff showing inflation decelerating and or outright deflation. There's, going sideways for many months, hopefully in the future, all the way to the health of the consumer and the housing and the economy being in a pretty good shape heading into this. And then sentiment, what seems to be across the board. I know you can nitpick and pull other indicators as well, but sentiment being kind of like a third leg of this stool. What's your views on sentiment broadly? Any stats you got?
Yeah. So, I mean, whether I'm looking at consumer sentiment or investor sentiment, they're
Good point.
all, close to the basement level or just coming out of the basement. The consumer is coming, just out of the basement level. We've actually seen, I think, 2 months now of University of Michigan consumer sentiment rising. Inflation expectations are falling. Consumer confidence had a big jump based on the last conference board's update just yesterday.
That makes sense
Investor
with the
sentiment, yeah,
S&P data that I was talking about.
yeah, investor sentiment, whole different situation,
Mhm.
obviously, based on that chart that you were just showing, and AAII survey as well as investor intelligence survey. I mean, they're all in the dumpsters. Investor leverage, whether what depending on the cohort of investor class that we're talking about, whether it's hedge funds or long equity portfolios, they all extremely low leverage. Nobody wants to, be over leveraged in an environment where the Fed is quote unquote removing liquidity from market systems. So when I see a chart like the one that you show, where we have those massive spikes in protection, it automatically just it rings in my ears. The old saying, from Warren Buffett, or maybe it was Warren Buffett, maybe not. When there's blood in the streets, that's what that chart just automatically, just see a big when there's blood in the streets,
Yeah.
um, and usually these are signs of troughing, if not basing points, in markets as well as in the economy when it comes to consumer sentiment. I think the biggest issue with this particular cycle is that while you have consumer sentiment still in relatively basement levels, you have retail sales doing this. So
Strange.
this is the first time that's really ever happened where you have that kind of juxtaposition. So it forces you to realize that there is some nuanced differences about this time. Nobody likes to say this time is different, but the reality is every time is different. The circumstances are always different from one cycle to the next, but human behavior really isn't. So this is not a pandemic. This is not a great financial crisis, but to the point of that chart, human behavior is still reacting to the uncertainty the same way. So, from a structural standpoint, in the markets, I don't participate in that fashion. I've never been of the opinion, and to be clear, this is just my opinion based on 22 years of experience as an investor. I've never been of the opinion that hedging is a good idea. I've never found that to be a good idea.
I
Um,
echo you.
well, I've always thought about it through the lens of, okay, if I'm hedging, something about whatever's going on is scaring me. So I'm going to open up a new position and think I can manage that well. Like, the logic is rather counterintuitive there. Secondly, it's a time-based bet, right? It's a hedge, so I'm not going to have it on forever. Do I think I'm going to be able to time the in and out of that new position while I'm already in a fearful state? We could just go down hedging is just a counterproductive process. The actual data on hedges collected by the CBOE says that 80% plus of hedges fail to meet their intended purpose. So charts like that, sentiment overall, I think is getting better for consumers, but it's only worsening with price. As price of the indices are going down, you see sentiment getting worse, leverage getting worse, and it's all tied to one thing: when is the Fed going to signal some type of pivot? So I think that there are going to be a lot of folks that are leaning so heavily, as they were in that chart, to one side of the boat with that sentiment. When the tide goes out, they basically run onto dry land, and they're not going to sail away with the ship that brings in the new bull market and strengthening economy. I've always been an optimist. That's
Yeah,
the
I think
way
you
I've
have to be.
approached. I'm sorry.
Yeah, I think you have to be in this profession.
Yeah, doomsdaying and just worrying about your P&L and your portfolio. If you're an investor, invest. Give it more time. The market tells you what it's going to do over time. It goes from the lower left-hand corner to the upper right-hand corner. You want to be on that ship. In the meantime, you pay the price of volatility.
Yep.
That's time.
Now let's talk about valuation. You had I'll pull up your tweet. Oh, not your tweet, but let's see where it is. Here you go. So there's a couple different ways to look at it. I think what you hear anecdotally is today's PE is call it 17, and average PEs are 15. We're not even close, and CPI and kind of all the adjustments you can make to many of those. I, for one, think if you strip out, and there's plenty of data around that, you strip out the big companies, the biggest companies in the index, i.e. Apple, 28 times, has a large effect on that average these days
Yeah.
relative to before. Where the index is highly concentrated today, I think that's been well articulated. I don't think people have thought about like the second, third order effect of that, which is that that also affects the average PE of these indices. And if you strip out the top 10, which you could arguably say, why would you strip out the top 10? They're obviously big and strong and well liked. But if you do, you get obviously another 490 companies, and you get an average PE across that of 13 times, which is well below the average. That's interesting. There's other ways to look at it, and I think that's how you looked at it here, which is how PEs troughed, trough PEs, in addition to the derating cycle that takes place during derating periods. So just share like
Yeah.
those tweets you made, what you meant, and how we should perceive this.
Yeah. So, firstly, when we hear about, the market is not going to bottom until the PE is 14 or 15, because that's basically the average of past recessionary trough points for the S&P 500 PE ratio. The reality is we're always using a small sample size, right? Because there's only been a handful,
Yeah.
of recession. From a statistical data standpoint, that's just a bad idea. The smaller sample size, the less significant or relevant the data that you're studying. The other thing is, when people talk, well, the average P, how often do we hit the average, right? Never. We never actually hit the average. So, from a former PE, a trailing PE ratio standpoint, you would have been upset if you had been waiting to allocate capital until the PE got to that average. What I found more useful is because when you look at PE ratios, they do trend higher over time. The argument or pushback to that is that, well, we haven't actually hit or stayed above the 2000 or the dot-com period PE multiple. But still, if you do a mean regression trend line, they travel higher over time. PEs expand over time, whether it's CAPE or just your general forward-looking 12-month PE ratio, they both travel higher over time. So if you have a static component, right? We're talking about PEs. If the PE is never constant, it's always static, it's always moving higher over time, and it's just kind of capturing energy for the next push in the average 5 or 10-year PE multiple. If it can't be constant, then we have to look at it a different way. So the secondary way that I was looking at it is, okay, if we're going through a derating cycle, a correction, even a recession, from peak to trough, what is the typical or average derating of the multiple? How many multiple points do we derate, from past cycles? And I found that the average is about 7 from peak to trough. And this enables you to accept the reality, which is PE multiples expand, and it validates the fact that using an average is just not useful. There's no utility in using the average PE ratio from past trough cycles for a static component. So that's kind of how I came to surmise that it's better. The greater utility for capital allocation is to recognize that the typical derating cycle is about 7 points. And lo and behold, from peak to trough in this particular cycle, and I'm using a forward PE multiple, we started at 22, we got down to a peak of 15, trough of 15, 7. Now it doesn't mean that we're going to stay there or and bounce and what have you, but this gives me more utility. All I really want to do is formulate a model for capital allocation. I can't do that looking backwards at past average PE ratio troughs. I can use that accepting the principle that PE multiples expand over time. So where's my top? And if the typical derating is 7 basis points, if it gets down there, I can allocate capital.
Makes sense. I like it. Yeah, that's why I wanted you to share your not only the data but and the takeaway, which again correlates well with what your average derating cycle was. Next, I think last little section here is we've gone through inflation data, the economy, sentiment, a view on inflation or on valuations. Lastly is the Fed. Can they pause? Should they? Would they? Could they? I think we've thought about it a little bit here. I'll let you go first and kick off, and then I'll maybe add some stuff.
Okay. Based, I'm data dependent. All my theses and models are based on the data.
Yeah.
And based on what I've aggregated and analyzed, I think the Fed is at a good place where they can start messaging a softer tone. And the market wants to know. The market likes definitives. It doesn't like uncertainty. So all the Fed really has to do is start tempering its message, where it's been extremely hawkish, aggressive, and acted upon that. Any deviation from that, any softer tone, will start to be received well by the market. Is that a pivot? In my books, yes. Anything the Fed does to shift, dynamically is a pivot. It doesn't mean that they have to cut rates.
Right.
There's just various, just like anything else, there's nuances. I think there's no definition behind pivot, right? When it comes to the Fed, I think it's all abstract, and we have to consider various forms of what it means for the Fed to pivot. I don't think that they should pause until at least December. I know they only have 2 meetings left. I think they go at this one. The market's priced it in.
You say pauses in no more rate hikes as opposed to 25 or 25 or 50 or 50. So
I think,
your
I think
definition of pause is 0.
Correct. No further rate hike. So if they go 50 or 75 at the next meeting, I think that's ample enough, to pause there, review the incoming data, which we will have the CPI print before the next meeting.
Right.
So they'll have that one. And then before the December, the final meeting of the year, they'll have another one, which, if all the data is that we're aggregating, high frequency or otherwise, it does play out in the CPI and PCE readings, that will solidify the disinflationary trend, and it will give the Fed enough cover, to where can fully say, now we want to see how things take effect in the economy, as if they haven't already to one degree or another. But there's always that prevailing notion that the Fed's policies have a lag time. I don't know about you, but as soon as they started hiking rates, we saw yields go up, we saw mortgage rates go up, and we saw immediate impact. And in fact, there's been studies from the New York University that says, in past decades, that's been true. That there's been at least a 6 to 9 month lag before you see the impact of Fed policy in the economy. But since the turn of the century and since quantitative easing, we've seen much more rapid response from the economy and or financial markets. So a pause, I think, after the November, but it is dependent upon the incoming data.
Yeah. I mean, I'll just summarize that as well. And look, I I don't know about the pace of which they need to go forward. I don't think they have to do too much more. I think all the data that we've already shown has supported the notion that a lot of work has been done, and I think you just alluded to it. Whether it's the yields, everything in the real economy has already adjusted, and the only thing that's lagging is the actual Fed fund rate. And so it's whether if you're them, and this is what people have to just be cognizant of is until you're actually ready to pause or pivot, whatever we want to frame that as, you shouldn't show any form of weakness.
Mhm.
Now, I think over the last several weeks, there's functions of like the U.S. dollar and such, and the implications there, how that could eventually spill back, anyways. So they have to stay cognizant of that. I do think they're at a good point where they could pause. And now the question is when do you signal it? Do
Yeah.
you wait another month and let what you just have done flow through the economy? I think we got a little bit or like over the weekend. Like a lot of this stuff is structured and signaled. They communicate internally. You better believe any sort of headlines are purposeful for the most part.
Yep. Yeah.
We saw this, and
Yep.
Fed Evans basically say he's getting a little nervous about going too
Yep.
far. I'm assuming again that the rhetoric over the last week has been that exact comment. So understanding that inside that room there is a single individual that at least thinks that is an important signal. It
Right.
doesn't mean a pivot or anything. It just means that they are aware, and I think that's an important purposeful signal that we should be paying attention to. Now, again, what does that mean in terms of how and when and if? For me, I just thought that was an important sign. Again, I am an optimist, so I am looking for, I understand that bias as well. I am looking for those little nuggets of optimism. But I also think what we just went through this exercise showed enough of evidence that inflation is being tamed, whether it's through the real economy and the Fed's work kind of being done or having a real impact. Two is the valuation component you talked about, sentiment being pretty weak. I don't know. It just, you go back and you think about, when are there great opportunities to invest? And this isn't recommendations from any of us, but it's just simply a lot of the damage, I think, has gone a little bit too far relative to the health of the economy and the valuations and such, and some of the stuff you're hearing from the companies. I wanted to give you another minute to just share where people can find more about you.
Sure.
I know we've been running for a long time here, and there's a hurricane out there, and we got stuff to do. But in general, I just wanted to give you, a moment to
Appreciate it.
find more about you.
Yeah, I manage and direct phenomgroup.com. We started that in 2017. It's a great place. I came from the sell side analytics world. I did macro research reports as well as stock specific research reports for hedge funds and institutional investors from 2011 to 2015. And we got acquired. My first company got acquired, so I had like a 2-year non-compete. And then we were able to restart as phenomgroup.com. So every week we offer a what I call a macro market research report, focusing on the disciplines of investing, technicals, fundamentals, and quantitative data. So every week you get a really detailed analytical report, that basically covers all your bases as an investor. And it also just teaches, one key principle, which is the more time you have in the market, the better opportunities you're going to have to profit from the market's long-term trend. Investing, if it was all about the IQ, all read and study the same books and we get the same results, but it's not. It's about your emotional capacity and how you handle situations in the economy, let alone such as they are here in 2022. On Twitter, you can find me at Seth CL, which was the first domain name of our company that got acquired. It was Capital Ladder Advisory Group, so the CL has stood. But yeah, you get also we do a weekly what I call State of the Market at Phenom Group, and it's a video podcast where once again, during the course of the week, you kind of want to have those touch points with the market for about 45 minutes of really strong analytics Again, technicals, fundamentals, and quantitative data. And that's delivered every Thursday. Our macro market research report is every Sunday. And we have a really good community of investors from all walks of life, retail investors up to institutionals. In fact, some of our work is white papered by Wells Fargo, Credit Suisse, Hightower Advisors, and a number of other institutions. So that's where you
Cool.
can find me.
Yeah, I'll put that stuff on the show notes. But with that, Seth, I wanted to let you go.
Thank you.
Appreciate you having on, and yeah, well, we have to do this again.
Be safe there in Miami.
Yeah, same with you, Seth. All
Take
right,
care.
man. Good stuff.